The problem with checklists is this. Your checklist will grow and grow and grow and grow, and you'll end up with 20 items to check. Just like your share investment. If you go back and look at the shares you have invested in, it'll be pages after pages. You only wanted to list in 10 stocks. But now when you go through your listing, it's about 35 stocks, 40 stocks. Okay, something is not right when you have such a long list. And why is there a long list for checklists and a long list in your stock portfolio? One reason. FOMO, fear of missing out. So in stock list, every time you hear, this stock sounds good, buy, keep. This one, good. I don't want to miss out, fear of missing out, buy and keep. And your checklist also grows. Check this, check that, check this, check that, check this, and it's a long checklist. So before today's sharing session, I was thinking of how can I summarize and put it in 4 words? 4 very important words for every share investor. 4 minimum checklists. You can have a checklist, but my recommendation, not more than 10 lah. Don't look at more than 10 items. It's up to you to figure out which 10 is important to you. But I'm going to share with you 4 items. And these 4 items are very common. Even the previous speaker spoke about these 4 items. So how do you remember these 4 items? You remember MIME. M-I-M-E. MIME. Malaysia, India, Malaysia, England. MIME. So what do these 4 items stand for? The first M is something you heard earlier this morning. It's called the margin of safety. The margin of safety. And the second item, I, is the intrinsic value. The third M is something that Warren Buffett calls as moat. M-O-A-T, moat. And perhaps 4th item is the most important item. You think you can master it, you will never be able to master it forever. The 4th item is the E. It stands for? Anyone? Any guess? What does the 4th item stand for? Emotion. Stock market investing is a lot about emotion. And we all know what's the 2 greatest emotion. Fear and greed. So think of MIME. M-I-M is about fundamentals and the E is about emotions. You think you have mastered your emotion, but every time you think you have mastered your emotion, remember you haven't mastered your emotion. So improving chances of winning in the stock market. Why is this not moving? Go down. Okay. So why do people lose money in the stock market? First point, now many of these points Warren Buffett has already mentioned it, but it perhaps needs to be re-emphasized. We need to remember these points. Focus on share price instead of business. Okay? That is one reason why we lose money. We don't look at the business, but we look at the share price. Share price can change every day. The business doesn't change every day. So how to rationalize? It's not logical. The business, Nestle, is the same today and day after tomorrow and tomorrow. More or less the business is the same for the whole week. But the share price goes up and down. And straight away you know there is a difference. Price is no more that important. It's important. But price can move when the business doesn't move. Okay? So better investors invest in the business. So we react to volatility. Related to the first point, share prices can go up and down. And what happens? The E kicks in, emotion. Wow, share prices are dropping every day for the last 3 days. Fear. you tend to sell the share. But remember, in 3 days, the business has not changed. Nestle's business or any other good company's business has not changed, Dutch lady. I'm not recommending Nestle, or Dutch lady's business has not changed in 3 days, but the price changes. So it's either fear or greed, and we react. And as you all know, buy the greed and sell the fear. We have heard this so many times. Warren Buffett saying, be fearful when others are greedy. Be greedy when others are fearful. When everyone is chasing up the price, becomes so high, people are greedy. Emotion of greed. That's when we must be very careful. Good example is the glove companies. You all remember the glove companies? Wow, top glove went up to 20 ringgit, Hatha Lega, Kosan, everything went up. And what happened? Some people say, they waited and waited and waited. Finally, they said, I want to enter. So they entered the market at very high prices. And you know what happened next? All the prices began to drop. And drop, and drop. And finally, all these glove companies, they reported losses, quarterly losses. Okay? So, when share prices go up, people are greedy and chasing up the stock. Be fearful. Okay? Emotion. Most of you would know about this particular cycle. Optimism, excitement, thrill, euphoria, up and down and up and down. The stock market is a cycle. Sometimes even your stock prices are a cycle. You know what's the problem with us as investors? The problem is this. We very often are kiasu. You know what is the meaning of kiasu? We want to buy at the lowest price and we want to sell at the highest price possible. After we sell, no one else should make money. Very kiasu one. Lowest price, highest price. You sell at 10 ringgit and goes up to 10.10, you're so upset, although you bought the stock at 3 ringgit. The fact you made 7 ringgit is discounted. I sell at 10, the other fella made 10.50. Someone advised me once, they said, Deva, whenever you sell in the stock market, you must allow that buyer to make some money also. Be decent about it. Don't you want to make all the money? Okay, so it's perfectly all right. So as long as we realize that we don't have to buy at the lowest or sell at the highest, it's all right. Let other people make some money too. So many of you will be able to relate to this. So going up, rather than wait for euphoria at the very tip, when you're feeling thrilled, sell the stock. Okay? Again, I think you've seen this man's picture so many times this morning, but you cannot run away from this man. He is the guru of fundamental investing. Invest in what you know, or as he calls it, the circle of competence. Never invest in a business you cannot understand. This rule has helped me a fair bit. Sometimes we invest in businesses that we do not understand. Cryptocurrency. I don't know how many of you all really understand cryptocurrency and blockchain. I don't. I will never invest in it. Sometimes we hear tips and rumors. I'm famous in Malaysia. I heard it from the horse's mouth. I heard it from the horse's mouth. But the horse, we don't know which horse. Okay? Rumors, tips are very common. So sometimes we buy, we don't understand the business. Wrong. You must part with your hard-earned money in a business that you understand. What does the company do? You look at Bursa Malaysia today, they have 840 odd PLCs. Some companies, you have no idea what they do, They make announcements. They write beautiful annual reports. But we go through, hey, what do they actually do? You're not sure. So advise stay away from such companies. Other companies, you know exactly what they do. Dutch Lady, Nestle, even Carlsberg. Know what you own and know why you own it. Now, I work at MSWG. Every Friday, we publish a newsletter. You all can become members of MSWG free of charge. Malaysians love free of charge. Go to MSWG's website, sign up, free of charge, become a member. And when you become a member, you can read our weekly newsletter. And last Friday's newsletter, we wrote about 2 principles of Warren Buffett. One principle was, you should write a thesis every time you buy a share. Every time you buy a share, you must actually sit down and either type or write, why did I buy that share? After writing, why did I buy that share? Look at what you have written. And if you are comfortable, go ahead. Okay? The thesis is very important. So in the Friday article, the other point we covered was what Warren Buffett calls the 20 punch hole principle. 20 punch hole principle. Many of you were born after the punch cards. You know, we used to have punch cards, where when you go into work, you insert the punch card, it'll punch holes. Now what this 20 punch hole principle means is that you only get 20 chances in life. You only get 20 chances to invest in the stocks. Think carefully and invest. I suppose by extension, your investment list should not be more than 20 shares. Remember, investment listing has the habit of growing and growing. Got 840 listed companies, 20 only. If you find you have more than 20 shares, force rank. Choose the top 20, keep. We all have heard about 80-20, okay? Pareto's law, 80-20. You'll find that 20% of your investment will give you 80% of your returns. When you buy, you must monitor the stock. More than 20 stock, even more than 10 stock, difficult to monitor. Read the announcement, read the annual report, read what the analyst is saying about it, read what's in the media, what's in the blog. Nowadays blogs also got. How are you going to monitor? Okay? So coming back, know what you own and why you own it. So go back today, take out your list of all the stocks, ask yourself this question, why am I hanging on to this stock? If you can't give yourself a convincing answer, sell. If you can't give yourself a convincing answer as to why I'm still holding on to this stock, it's time to sell. Okay, the other thing is you must read widely, and this is one of the better books around town. Investing is more intelligent when it's most business-like. So we must treat investing as not a hobby, as a business. When we do business, we are disciplined. We don't open a restaurant and then just sit at home the rest of our lives. We go into the restaurant, see what's happening and all that. So if you treat investment as a hobby, it'll just be a pastime. But if you treat your investment as a business, professional, discipline, my checklist, my reason for investing, every now and then, every time, ask yourself, am I being emotional? Is it fear? Is it greed? Sometimes you'll give the wrong answer to yourself. Okay, so you have to always ask that question. So you must be more disciplined, business-like when it comes to investing. Sources of information nowadays, too much information. They call it the information overload. There you are, all sources of information now. So much information. So they have this phrase called information paralysis. You're waiting to be absolutely sure whether to buy the stock or not. The more you read, the more you want to read, you read and read and read, and by that time what happened? The stock price has either shot up and you can't buy. Yeah? So there's a lot of information available, but guess what? End of the day, you must make the decision. Even research analysts don't help. Research analysts, professional, licensed, qualified research analysts, they don't help you much. You know why? 10 analysts go for the company briefing, 3 say buy, 3 say sell, 4 say hold. How? Read all, but you have to decide on yourself, on your own. Huh? No one has the right to make you lose your money except yourself. And if you lose money, don't blame others, don't blame regulator, don't blame market, don't blame management. You make money, you always say, wow, I'm a good investor, you know, I make money. But when you lose money, oh, what's Bursa doing, what is SC doing, you know, or manipulators in the market, this and that. We must take responsibility and accountability for our investment decisions. No one has a right to make you lose your money except yourself. Read wide, but be careful. If you read too wide, information overload. Maybe I should say read just enough. Three R's. Right business, right management, right price. So you want to go into the right business and at the right time, the right business. And when you look at the listed companies, you know, many of them are in the right business. So there's something for you to decide. Right management is very important. Board is important, but management is more important. You know why? Management come to work 5 days a week, every day. Board comes in maybe 4 or 5 times or 6 times a year. Management very important. So go through the management list in the annual report, look at their background, their qualifications, and also go through the board, who the board members are. And paying the right price is very, very important. Remember earlier you heard price and value are 2 different things. Price is what you pay, value is what you get. So right business, sunset industry is the wrong business. You know the business is going to go. Good example is newspaper. Okay? The Star, Straits Times. The hard copy newspapers are going out of business. Nowadays, even their virtual news is so competitive. People are coming and spoiling the market by giving free newspapers. You know, the Age Financial Daily, free of charge. The Sun newspaper, free of charge. So, this is becoming like a sunset industry. News is not sunset, but these companies always relied on hard copy newspapers. Companies with growth potential, companies that are growing, especially in the IT industry, could be a right business. Companies that have a broad market, target market. Immediately I think of Nestle and Dutch Lady. Go home today and look in your kitchen. Sure enough, you'll find something from Nestle or Dutch Lady. Either a Maggi Mee or a Milo or something. Okay? So this is a broad target market. Higher earnings per share and cash flow important, but be very careful about profit. Profit is an opinion. Profit is an opinion based on assumptions. Profit is an opinion based on the assumptions of management and the external auditor. Assumption. Cash is a fact. Cash is a fact. So, rather than being fixated so much importance on profit, pay more importance on the cash. Is the cash coming into the business? annual report got the cash flow statement. Is cash coming in regularly? Or if cash is going out, is it going out for the right reason, for investment? Cash. Remember, profit is an opinion, cash is a... If I say I got 10 ringgit in my pocket, I should be able to show you 10 ringgit. The problem with profit is this. I sell 100 million today, my cost is 80 million, I show profit of 20 million. But next year what happened? The 100 million I sold, no one pays me. So next year I impair, I provide, I this. By the time you are happily invested based on profits. Okay? Moats. Moats is something that Warren Buffett also talked about. Remember, I started off with 4 letters, M-I-M-E, margin of safety, intrinsic value, moat, and emotions. Now, moat is the protection that a company has got against, like say, competitors. The glove companies did not have a strong moat. That's why China produced so many gloves at so cheap a price that all the glove companies suffered. No strong moat. Even in Malaysia, some PLCs were diversifying to gloves. They bought factory, put up machinery and all that. That is an example of no strong moat, at least at that time. In Malaysia, if we talk about strong moat, offhand I can think of is maybe Genting. No other company I think is going to get a casino license in Malaysia. So in a way, Genting has got a strong moat as far as that is concerned. Maybe Carlsberg and Heineken, brewery, alcohol, in a way got a strong moat because I don't see the Malaysian government giving out more licenses for beer or whatever it is. So that maybe Nestle and Dutch Lady, because they got a strong moat. You want to become like Nestle, it will take many, many, many years. Their network, their product range and all this. Okay, that's the moat. Moat is the protection. So you want to put it in a mathematical way, it's like this. Intrinsic value minus share price equals to margin of safety. And that margin of safety is very important. Intrinsic value minus share price is the margin of safety. The problem with intrinsic value is this. You must come up with your own intrinsic value. Because every other fella around town has got his own idea of what the intrinsic value is. You know, to understand intrinsic value, look at how the stock market works. One fella sell, another fella buy. Why? Who is right? Who is more intelligent? The fellow who sells is selling because it's reached his intrinsic value, maybe. The fellow who buys is buying because his intrinsic value is much higher. Okay? So everyone can have and should have their own idea of their intrinsic value based on the research they do. That's why the market got buy and sell. That's why the market got transactions. The transactions in the market indicate that everybody in the market has a different idea of intrinsic value. Yes, I spoke about moats. It's very important. Moats is a protection. Now, those days when you have castles, to protect the castle from enemies, they build a big water, like a river around the castle, and then they had the drawbridge. So the water around the castle, the drawbridge is what they call moat, to protect yourself from enemies. So these are some examples of moats. Strong brand name. Again, I'm not recommending Nestle, but I say Nestle, everyone understands. Carlsberg, Heineken. Okay? Top Glove. Strong brand names. High switching costs. Competitors cannot enter the business very easily. Like all your telcos, They are very strong. Network effects where you have sales outlets and distribution. Low cost, they are able to produce their products at the low cost. And size matters. Because if I'm the biggest, it'll take you a long time to become bigger than me, unless you have mergers and acquisition. So the moat, the protection is very important. Okay, those are some of the points I wanted to share with you all. Are there any questions? Soalan, questions, comments?
Do you have any case study or real experience how like a small investor to lose money?
Okay, case study of how a small investor would have lost money. Okay, let me try to relate how a small investor or even big investors think when they invest. It's all got to do with fear, greed, and emotion. Now, I go and buy one share for 2 ringgit. Okay? I buy a share for 2 ringgit. And I tell myself, this share, the intrinsic value is 2 ringgit 30 cent. Or let's say 2 ringgit 50 cents. So I buy a share for 2 ringgit. I say intrinsic value is 2 ringgit 50 cents. That means as far as I'm concerned, that is the value of the share. Intrinsic value, the price is 2 ringgit. My margin of safety is 50 cents. Guess what? You're right. The share price goes up 220. You're happy. Next day, the share price goes up 240. You're happier. Next day, the share price goes to 250. You're happiest. You know why? Because you have reached your intrinsic value. You should sell. No, you don't sell. Greed comes in. Wow, from 2 ringgit can go to 250, surely can go to 270, I'll wait and see. I'll wait and see. My friends all say, don't worry lah, like that one, it's a winner. 2 ringgit, 210, 20, 230, 240, 250, 270, sorry. Okay. It goes to 270. You think you want to sell? Your share, you buy 2 ringgit at 270, you think you want to sell? You think Top Glove, they wanted to sell at 20 ringgit? The small shareholder will say, no, I'm on a winner. 290. Your 2 ringgit share is now 290. You want to sell? No. How to sell? And you think mad, I'm riding the bull. It's the bull. Next day, what happens? It dropped to 270. Do you think you want to sell? 290 I didn't sell. You want me to sell at 270? Crazy. 290 yesterday I didn't sell. You want me to sell at 270? You forget about the fact you bought it at 270 you want me to sell. Next day it drops to 250. Do you sell? 290, 250, 40 cents. No. Sure, bounce back a bit. I get off. Just wait for it to bounce back. Next day, 230. Wow. Upset. Maximum upset. Still making 30 cents. Maximum upset. 290 to 230, 60 cents. I'm sure you'll convince yourself. It's a blip. It's a technical. It's an oversell. But enough terms in the stock market to help you convince yourself why you should not sell. You hang on. Drop to 2 ringgit. The price you paid for the share. Anyone ask you to sell? Come on, you crazy. Ego kicks in. Because next day it's going to drop to 180. That's when ego is the strongest. You cannot accept the fact that it's a loss. Traders end up as long-term investors because of this kind of mentality. That's why you need strong emotional intelligence. I suppose you should always ask yourself in these circumstances, am I having any kind of behavioral bias? Ask yourself very strongly and very objectively, am I operating with fear or greed? Remember, you said at the start, you will sell at 250. Your share price went to 250. That is the intrinsic value you gave the share. Why didn't you sell? Emotions. So I hope I have, in a way, answered the question. It's got a lot to do with emotions. Sometimes the other way around. You buy the share for 2 ringgit, next day drop to 180. You will never sell. You know why? Ego. I cannot be wrong. I did so much research, I cannot be wrong. You wait. Drop to 160. More ego. 40 cents worth of ego. You don't sell. And the rest, as you know, can be very painful. You don't know how to cut your loss because your ego comes in. When it comes to investing, we do make wrong decisions. No one can make the right decisions all the time. It is to realize when you have made a wrong decision and to move on. But moving on is so difficult because of ego. Any other thoughts, comments? Okay. There will be a long checklist before you invest, but my advice or my sharing is do take the 4 letters, the MIME, into consideration. They are very important. The margin of safety, the intrinsic value, the moat, the protection, and most importantly is the emotion, the fear, the greed. The problem with emotion is that it's a conflict of interest. You are trying to analyze your own emotion. That's why it's so challenging. You're trying to analyze your own emotion, and it can be very challenging. It can be very difficult. So read a bit about behavioral science, the kind of emotions that investors face. Fear, greed, cognitive bias, anchorism. Any other thoughts, comments, questions?
All right. Maybe we can have a Q&A sessions.
Yep.
Anyone that would like to ask some questions for our speaker right here today? All right. That's it.
Hello, good afternoon.
Yeah.
So as we know, the fallacy of investing is really the emotions, right? So now there are solutions in place where we take the human element out of it, right? So we don't get, fund managers. We use very sophisticated algorithms, right? ETFs and whatnot. So very curious to hear your thoughts on that.
Okay. The question is about trying to take emotions out of investing. And some examples of taking emotions out of your investing is to transfer your emotions to someone else so that you are not emotional. Okay? Like fund managers, you need trust. You all think that, if I transfer my emotions, I'm no more emotional, I give these guys. But they are also emotional, in a way. Okay, fund managers. And of course, there's the cost of investment. Fund managers sometimes may not be as good as you. The advantage you have is because it's your money. you got what they call skin in the game. You invest your money, you can perhaps make a better decision than the fund managers. Fund managers, not my money, other people's money. That's why they always say, I'll come to you guys. That's why they always say there's a difference between investing in GLCs and investing in owner-run companies. You go to Top Glove, the owner of Top Glove has invested so much money in Top Glove. He has got skin in the game. Every ringgit Top Glove loses, part of it the owner loses from his pocket. You go to a GLC like maybe UMW or Bowstead or whatever it is, management and the board, they don't own the company. The company is owned by PNB, EPF, Co-op, SOXO, LTAT. So they come in, they make decisions, things go wrong, never mind, I don't suffer. The EPF members suffer. The LTAT members suffer. So in a way, it's good that I don't think you can transfer your emotions to a fund manager, and maybe it's not a good idea also. Like I said, if you want to lose your money, only you should be entitled to lose your money. The other example was given was about using algorithms nowadays, you know. The big investment houses, what they do is they come into the morning after having read all the news. They say, okay, today I'll just key in at this price. If it hit that price, sell. And okay, what if it drop? Okay, if it drop to this price, buy. And then they go back home and play golf. Because the model, the algo model, apparently is so powerful that it's already given you instructions when to sell and if it drop, when to buy. I'm not quite sure whether that would work. Sometimes it's good to have fear and greed, to feel the fear and greed for your emotions. I've not tried the algos myself. I know it's out there, and maybe your unit trust managers also use such algorithms. But maybe I'm at my age very old school. I rather feel my own fear and greed when it comes to investing. I rather lose my own money due to my investing rather than lose the money due to fund managers. Yes, sir. Can you? Don't know.
What percentage would you give to MIME? M is how many percent? I is how many percent? M mode is how many percent? E is how many percent? What's the weightage?
Okay, a very mathematical question. What percentage would I give to MIME? M how many percent? I? It's a very good question. Something for me to think about. But off the cuff, I think the E part, the E, emotion is very important. I probably give about 50% for emotion. 50% for emotion. Or maybe 40% because I saw someone look shocked here. 40% for emotion. The other 60%, I will say 20% for margin, 30% for margin of safety. No, 50% for margin of safety. 40% margin of safety, 40% for emotion, the other two 10%, 10%. I'll say why. The margin of safety is the margin of safety. You say the price is 2 ringgit, I pay 2 ringgit, but in my mind, although I buy at 2 ringgit, the value is 3 ringgit. Margin of safety of 1 ringgit. Okay? So if it goes up, it should go up, but maybe it doesn't reach. So margin of safety is very important. It is what you think something is worth. If I think something is worth 10 ringgit, the lowest I can pay, the better I feel. It's worth 10 ringgit. One fellow says, I'm 4 ringgit. The other fellow says, I'm selling at 3 ringgit. I'd rather go and buy from the guy who is selling at 3 ringgit because margin of safety is 7 ringgit. Emotions, I think I spoke so much already, fear and greed.
All right, thank you so much for sharing today. Because of time constraint, we need to proceed to the next session already. Thank you so much for our tips.
Thank you.
In terms of just now what Mr. David has shared, 3R, and all the tips just now. Thank you so much once again. That's right. As